Um, this is bond yields. So we typically here on this show are talking about equities, indexes, ETFs. But there is this other half of the market that is typically balanced in people's portfolios, and that's the bond market. So you're looking at a bunch of lines. What these are, I've overlaid the different bond yields on my graph here. And so what you're seeing here is, for instance, this one right here is our 1-month bond. And then over here, you've got, let's see what this one is. This is our 1-year bond. And over here, you've got your 5-year bond. And then you've got your 10-year bond and your 30-year bond. So what's interesting here is the 5, the 10, then you've got your 20 and 20 and 30, right? Is that what I said? Let's see. That's your 10 and this is your 30. This must be the 1 year. Yeah, 1 year. And then you've got your 1 month. And we actually can put our 6-month up there. Let me see if I've got it in there. Here's my 6-month. Let's see if I can put that in there. We'll put this over here and click like this and hit apply. Here's our 6-month up here. It only wants to show a certain number of bond yields at a time. So notice that the 6-month and the 1 month are above these other ones. Now, in the bond market, traditionally, if everything is working correctly, you would expect to pay people higher yields if they put their money in longer, right? Does that make sense? Like when you go and you buy a CD, you get better returns if you agree to buy a 10-year CD than, say, a 2-year CD. Right? It means you lock up your money. You basically allow the folks who are going to be using your money a longer amount of time to have your money at their disposal. In return, they give you higher payment, right, in the form of interest. Well, the scoop is that our shorter term bonds for quite some time have been at higher yields than, say, our long term. That's called a yield inversion. And when you can make more money by loaning out your money for a shorter amount of time, that's a yield inversion. And that has traditionally in the past been a precursor when there's a yield inversion to a recession, right? Now, what is happening is that we're getting closer and closer. So again, maybe people, instead of seeing these graphs, it would be easier to see this thing on, for instance, the numbers. So here's the 2-year. The 2-year is currently trading at about 4.24%. Now, if I put in the let's put in the 10-year. So the 10-year is trading at less instead of more. If I put in the, let's put in the 1 year.
Is this because the anticipation of lower rates ahead?
It's because the Fed did that fast raising of interest rates, which meant that short-term debt was worth more than long-term debt. There, it's really interesting that we're in basically, uncharted territory.